Welcome back. In this video, we'll look at some specific examples of items includable in gross income. So when we look at the income tax formula, we're starting right at the top, income broadly conceived. And in this video, we'll discuss prizes and awards, life insurance, unemployment compensation, and social security benefits. First, let's look at prizes and awards. In general, winning a prize or award, whether it's in cash or property or service, think winning money or a car or a cruise on a game show, these prizes or awards must be included in gross income. A real-life example here is of Richard Hatch, who won a $1 million prize on the show Survivor in 2000. The problem, however, was that after winning the $1 million, he never included the prize money in his income. The IRS was expecting to see the $1 million on his tax return because they watched him on TV too, but he didn't, so the IRS sued Richard Hatch. Well, it turns out that Hatch also didn't report $327,000 of income he earned being a co-host on a radio show, as well as $28,000 in rental income. Those weren't prizes, but nevertheless, Hatch demonstrated a pattern of not recognizing income that should have been recognized. So in early 2006, he was found guilty of attempted tax evasion and filing a false tax return. He ended up spending a total of 51 months, or over 4 years, in federal prison. Ouch. So if you're winning money playing Jeopardy or Wheel of Fortune and tallying up some winnings, make sure to report it on your tax return. There are a few cases where prizes and awards are not includable in gross income. This happens if the prize or award is made for scientific, literary, or charitable achievement, and the prize money is immediately transferred to the qualified charity. There's some other conditions, like the person did not enter the contest on their own accord, but the general idea is that if the person won a prize or award, then donated it to charity, the taxpayer never kept the money, and thus it does not have to be recognized. An example here is if somebody wins the Nobel Prize. The Nobel Prize comes with a cash award of the equivalent of about 1.2 million US dollars. The winners do not apply for the Nobel Prize. The winners are selected by the Nobel Committee. In fact, the committee keeps the list of people that are considered for the award secret for 50 years. Typically, a Nobel laureate will accept the award, but donate the winnings to charity. If this is the case, the $1.2 million is not includable in the Nobel laureate's gross income. As an aside, the University of Illinois is connected to 23 Nobel Prizes, whose winners counted as their alumni or faculty in the areas of chemistry, physics, medicine or physiology, and economics. Another excludable prize or award is one where an employee is recognized for safety or length of service. And even so, the exclusion is limited to $400, or $1,600 if it's part of a qualified award plan. So if an employee receives some artwork from an employer with $400 for her 25-year work anniversary, the $400 artwork is not includable in the employee's gross income. Related to this topic, gambling winnings are also includable in gross income, while gambling losses are deductible, but it's what's known as a miscellaneous itemized deduction. If, however, the taxpayer is a professional gambler, then technically the taxpayer can deduct gambling losses for AGI. However, the taxpayer has to provide strong evidence that gambling is the person's profession. So maybe provide evidence on the time spent gambling, how many gambling tournaments the person enters into, information on winnings over time, and other similar features. So let's do a few examples. For each of the following scenarios, let's think about the amount that's includable in gross income. So first, Phil wins $500 in a scratch-off state lottery. How much is includable? Here, because it's a prize, a lottery, all $500 is includable. Next, Ted won a car with $17,000 on a TV game show. He plans to sell the car next year. Here, the fair market value of Ted's winnings is $17,000, and it's all includable in his gross income. Al won the Nobel Prize of $1 million this year. Rather than take the prize, he designated that the entire award go to a tax-exempt charitable organization. So what happens here? Well, the $1 million is excludable because he won the prize for a scientific achievement and donated the winnings to charity. Next, Jerry was awarded $2,500 from his employer when he was selected as the most handsome employee for Valentine's Day this year. So what happens here? Well, all $2,500 is includable. The employee award is not for safety or length of service. It's just for being handsome. Ellen won a $1,000 cash prize in a school essay contest she entered. The school is a tax-exempt entity, and she plans to use the funds to pay her college tuition. What happens here? So here, all $1,000 is includable. Although she won the prize for a literary achievement, she entered the contest as well as kept the money. Then finally, we have Jean, who won $400 in the Office March Madness basketball pool. What happens here? Here, the $400 is includable because these are gambling winnings. The next important gross income item is related to group term life insurance coverage. Typically, when a person goes to work, the employer will provide some life insurance coverage and pay the cost or premiums on that coverage. Although the employee is getting something of value, that is life insurance coverage, but the employer is the one paying for it, it seems like this benefit should be includable in the gross income of the employee. However, Congress has decided that the life insurance coverage is good, and employers should provide it. Therefore, to incentivize life insurance coverage, employees do not have to recognize in their gross income the premiums paid by their employer on their behalf on the first $50,000 of group term life insurance coverage. However, if the employee wants more insurance coverage than $50,000 and the employer pays for it, then the premiums paid for coverage in excess of the base $50,000 will be includable in gross income. This inclusion amount is based on IRS tables shown in the next slide. So here is how this table is going to work. If, for example, you're 30 years old and your employer is providing you with $80,000 in group term life insurance, the premiums paid on the first $50,000 are excludable, while the premiums paid to cover the next $30,000 are includable at a rate of 8 cents per $1,000 of coverage for a 1-month period. Or if we multiply by 12, 96 cents per $1,000 of coverage for a 1-year period. So if you're receiving $30,000 extra coverage, we multiply 30 by 96 cents to yield $28.80. This means that in a 1-year period, you'll include $28.80 in your gross income for the extra $30,000 in life insurance coverage. This is actually quite a great deal, since $28.80 represents income. If you're, say, in the 25% tax bracket, you're only paying 1/4, 25% of the $28.80 in taxes, or $7.20, to get that extra $30,000 in coverage. It's a pretty reasonable deal. Some other points here that if the plan discriminates in favor of key employees, that is, the life insurance premiums paid by the employers are only for the benefit of officers or executives and not all employees, then the key employees are not eligible for this exclusion. They'll need to include in the gross income the greater of the actual premiums paid by the employer for all the insurance coverage provided, not just the amount over $50,000 of coverage provided, or the amount calculated from the premium table shown on the previous slide. Again, this rule is designed to discourage companies to offer group term life insurance only to its executives, but rather extend the offer to its rank and file employees as well. Another item includable in gross income is unemployment compensation. So when a person is laid off and draws on state benefits to receive income, the compensation is actually includable in gross income in full, similar to as if the person had kept working and was earning wages. During the financial crisis, when many people were laid off, the American Recovery and Reinvestment Act of 2009 excluded the first $2,400 of unemployment income from gross income, while the rest was includable. However, in 2010 legislation, Congress did not extend this exclusion. The last item that has implications for gross income is receiving Social Security benefits. As we discussed in the previous slide, while a person is working, he or she will contribute through payroll or employment taxes into Social Security. Then when the person retires or becomes disabled, he or she will collect Social Security benefits, or cash from the government. However, the law requires that certain taxpayers must include those Social Security benefits in their gross income, and thus pay tax on these benefits. So it's an interesting treatment, given that the benefits arose because of a tax paid in the first place. But then when they're paid out to you, they are taxed. So you're not really getting the entire benefit. The rules here say that lower income individuals can exclude 100% of their Social Security benefits from gross income. On the other side, higher income individuals can exclude only a portion of their Social Security benefits, such that up to 85% of their benefits are included in gross income, and thus taxed. Middle income taxpayers will have to include half of their Social Security benefits, but can exclude the other half. And when I say lower, middle, or higher income taxpayers, the income I'm referring to is income before considering Social Security benefits, but it might include other income as well, including tax-exempt income. The calculation here is pretty cumbersome, but the point is you should be aware that although taxpayers might receive cash from the government, the cash might still be taxed. So in all, as we've seen in this video, prizes and awards, unemployment benefits, some life insurance, and some Social Security benefits are includable in the taxpayer's gross income.